Good evening, ladies and gentlemen. You're watching NDTV. The Reserve Bank of India on Friday kept its key interest rate unchanged, citing inflation risks, but cut the cash reserve ratio that banks are required to park with the central bank, boosting money with lenders to support a slowing economy. Now, experts have said that the Reserve Bank's credit policy was on expected lines, and the reduction in the cash reserve ratio, CRR, would help support growth after the sharp downward revision in the forecast for the current financial year. Simply said, CRR is the percentage of the bank's total deposits that it is required to maintain in liquid cash with the RBI as a reserve. Now, RBI Governor Shaktikanta Das has flagged the persistent food inflation in his explanation for the majority decision. Governor Das has also noted that high-frequency indicators suggest the slowdown in domestic activity has likely bottomed out, with recovery driven by festive demand and increased rural activity. Now, does this decision reflect a cautious approach to persistent high food prices and slowing economic growth? Will this move help ease out the liquidity situation, supporting credit and overall growth? And how is all of that going to happen? For that, let me go across to my colleague Sakshi Bajaj, who has more details on this. But first, let's listen in to what Governor Das said today.
Monetary policy is forward-looking, so we have to always look at the outlook. The Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%.
Six-member Monetary Policy Committee unanimously in a 4:2, like you said, has decided to keep the key lending rate unchanged at 6.5% for the 11th straight time. So what does this mean for you? Well, it means that there is no change or no relief in your EMIs at the moment. However, in a big move to boost liquidity in the overall banking system, the Monetary Policy Committee slashed the cash reserve ratio by 50 basis points. The RBI governor has acknowledged, remember, inflation and growth concerns in the near term, and has also lowered the FY25 growth target to 6.6% as opposed to 7.2% earlier.
To discuss this, we have Prachi Mishra, former Chief Systemic Issues Division, International Monetary Fund. We have Dr. Jagdish Shettigar, who is a former member, PM's Economic Advisory Council. We also have Arnab Deb, Professor Economics, IMI Delhi. Thank you all of you for joining me on this broadcast. To you, Prachi Mishra, first. Ma'am, how do you see the implications of this decision, the impact of this on banks, customers, and also the economy?
Thank you, Vasudha. Pleasure to be here. Let me start by giving a little bit of broad context. This is really challenging time for the RBI, the MPC, and more generally for Indian policymakers. Number one, global uncertainty. As you know, former President Trump won the re-election. Republicans have secured control over the Congress. This has really important economic and market implications for the global economy and markets, and therefore also for India. Second, I think, as you point out, growth has been slowing. The Q2 FY25 growth dropped to a 7-quarter low of about 5.4%, sharply below expectations. The RBI reduced their growth forecast by about 60 basis points to 6.6% in FY25. And at the same time, what is challenging is that, headline CPI inflation was reported as above the upper end of RBI's target band in October, and is expected going forward also to remain close to the upper end of the band in November. And RBI actually raised its inflation forecast for FY25 by 90 basis points to 4.8%. And on top of all this, INR is at a record low. And following Trump's re-election, dollar has strengthened significantly, which means that, EMs, including India, are seeing significant capital outflows. FIIs, for example, sold a record of $11 billion in Indian equities in October alone. And probably there's more room for further dollar strength on back of higher tariffs. So against this background, policymakers are really walking a tightrope. So preserving hard-earned macroeconomic stability is really key. And inflation is regarded as the most thorough indicator of macroeconomic stability. And bringing it down to 4% is really a goal of the Indian IT framework, which is enshrined in the law. And the RBI governor himself reiterated that, the RBI's commitment to the 4% headline inflation target. And at the same time, RBI is projecting a more positive outlook for growth going forward. So indeed, some of the high frequency indicators of demand, like, if you look at passenger vehicles, two-wheeler sales, they're all recording high growth during festive season.
Right.
So overall, I think given these trade-offs, I think, MPC has taken a prudent approach. How this will affect economy, I think it'll work through a number of channels, through interest rates at different maturities, through exchange rates, asset prices. If you think about high interest rates,
Right.
they increase the costs of borrowing and reduce demand. But at the same time, high interest rates are consistent with low inflation. So bottom line, Vasudha, there are no easy answers. I think monetary policy is as much of an art as a science, and there's always a fine balance which policymakers have to strike.
Right, so no easy answers there, but of course, a fine balance is what the RBI seems to be looking for. Dr. Shettigar, many experts are also saying that the decision of the MPC was along expected lines, with the CPI inflation exceeding the MPC's upper threshold of 6%. But what has really prevented RBI from being proactive and cutting rates when the growth slowdown is quite visible? Okay. Dr. Dev, would you like to take that question, sir?
Yeah, I think this is a situation, as it was clearly mentioned, that it's a very challenging time. And if you look at the policy, I mean, it is a neutral stance RBI has taken. And this is a very hawkish view with which he has mentioned, RBI governor, that it is a withdrawal of accommodation. And now it's time to take some measures, but at the same time, the CPI inflation, which is creating the trouble, and especially the food price inflation, which is mainly sourced from, I guess, from the vegetables, and that is why the 6.5, the status quo, they have maintained the status quo. But there is a question whether it is good for the common man or whether it is good for the Aam Aadmi. But at the same time, remember, we have found that they have also cut down the CRR, which is very much complementing the status quo in repo rate, because it is actually easing the liquidity. So on one hand, definitely they have kept it tight on the repo rate, but at the same time they are giving some flexibility to bank, and especially that will give them some space to breathe, especially lending out to the MSME sector, which is a very top priority for the Indian economy right now. So I would not say it's a very conservative policy by the MPC this time, but this is, I think, a neutral which is taking care of both the inflation as well as the growth, because growth is slowing down. So right now, if the inflation goes up, and as rightly mentioned, the dollar is getting strengthened, so to keep the rupee in a very stable manner, I think keeping this repo rate at 6.5%, I think it's a very prudent step RBI has taken today.
Right. Prashant Mishra, how will this cut in CRR also play out in the financial system? Will it help push credit growth, which has slowed down considerably like we saw? And of course, when is the rate cut cycle going to start?
So Vasudha, banking system liquidity had tightened recently. So likely it was driven by, FX sales by the RBI. As I mentioned, FIIs, foreign institutional investors, really sold a record. That had tightened financial conditions and pushed the interbank rate above the repo rate. So the cut in CRR, the cash reserve ratio, is expected to infuse, durable liquidity in the banking system. And I think it's estimated at 1.2 lakh crores. So this would, bring the interbank rates to trade around or even below the repo rate in the near term on the back of this announcement. And ultimately, I think what the CRR cut would do in simple terms, ensure supply of liquidity. Whether and how much this pushes credit growth would depend on the demand side too. And coming on, when is the rate cycle going to start? I think it'll really depend on the incoming data. I think two things, if inflation falls in line with RBI expectations, on easing food inflation with a good swing of summer crop. And secondly, high frequency indicators of economic activity continue to be soft, that would open space to cutting rates.
Right. Dr. Shettigar, the real estate industry players and other stakeholders have largely welcomed the RBI's decision today. But, what does this actually mean for home buyers and also developers?
No, I think this is the most sensible approach by the Monetary Policy Committee. In fact, I feel comfortable after very long time, probably more than 2 years of this. I have been a critic of the RBI's policy, but today I felt quite comfortable because keeping in view the prevailing situation, that is the threat of inflation and also deceleration in the growth rate, and also the apprehension about the outflow of the portfolio investment, and especially after the getting a signal from the Federal Reserve. Keeping all this aspect, I think they have initiated a very sensible policy approach. Now, people have been telling that the repo rate has been kept intact. They are not changed. But whatever the repo rate could have achieved, I think indirectly they are achieving by cutting the CRR by 4. Because by reducing the repo
we'll try connecting with him again.
reduce the lending rate by making the borrowing the cheaper. But here, by cutting the CRR, you are putting 1.16 lakh crores into the system. That is by raising the money supply. Now in this, either they could have cut the SLR or they could, the CRR. Now between the two, I think by cutting the CRR by 0.5%, they are infusing 1.16 lakh crores, which with that the money supply will increase, and with that there will be softening effect on the lending rate. So whatever they could have achieved by cutting down the CRR, indirectly they are trying to achieve by cutting down the CRR. And apart from that, it also indicates the confidence in the banking system. That is, because why we are, this CRR system, a long back, there used to be about 14% CRR, that is around in the 1991. From 14% CRR, we have slowly come down to 4.5, and now they have decided to cut down further to 4%. That shows the confidence in the banking system.
Right.
Mainly because of the improvement in the health of the bank.
Okay.
And
Professor Dev, would you like to comment on that? Also, we touched upon the geopolitical situation. Can we also expect to see aggressive rate cuts in 2025, not just in India, but also elsewhere too?
Vasudha, I can jump in if you think.
Yes, Prachi Mishra, yeah.
I think it's very heterogeneous. I think if you look at advanced economies, for example, they had much higher inflation during the post-COVID years. And they saw the most unprecedented and synchronized tightening of monetary policy, which actually may have helped anchor inflation expectations too. And therefore, inflation ebbed as swiftly as it rose. Advanced economies, given that they tightened much more, would need to reduce much more as well. For example, if you look at the United States, Federal Reserve has already cut 75 basis points, and it's perhaps more than 100 basis points to go. On the other hand, if you look at Japan, it's on a hiking cycle. Pick up in inflation and wage growth after 3 decades of anemic price pressures. Basically, Bank of Japan exited from the negative interest rate policy. Similarly, if you look at emerging markets, there's a lot of heterogeneity. Brazil is actually an overheated economy, and we are likely to see rate hikes there. Most of EM Asia, of course, will be on a rate cutting cycle. However, stronger US dollar really complicates the situation, especially for some of the exchange rate targeters in Asia. For India, I really don't see a deep rate cutting cycle. I think the real rates are fairly close to neutral. So I would not see more than 50 basis points or so in this in this cycle, unless the slowdown becomes really entrenched.
Right. Right. Prachi Mishra, also, given that we didn't talk about inflation as yet, the food inflation thing, something that the ministers have also spoken about, especially Piyush Goyal. RBI today also raised the flag that core inflation can increase as several manufactured and service industry products have witnessed increase in costs and hence prices. What do you think we can expect on that front?
See, I think, first of all, any central bank, including, the Indian central bank, they look at different measures of inflation, or and they look at the data in a lot of detail. I think the issue is that food inflation, or elements of headline inflation, like food and oil, can feed into inflation expectations and lead to higher underlying inflation, and this can become like a self-fulfilling spiral. And given that, I think macroeconomics, preserving macroeconomic stability is really a priority, especially in this uncertain world with geopolitical and geoeconomic uncertainties. I think this is what policymakers don't want to get into.
Right.
And that's where they are really walking a tightrope. When they have growth slowing, but at the same time they don't want to risk some of these food items or other items which are non-core to actually feed into inflation and get entrenched.
Okay. Professor Deb, if you can hear us, will this also lead to more efforts, say, in the field of innovation and, facilitate the deployment of more technology so that, credit access is simplified and in some ways financial inclusion is also strengthened? Do you think changes happening there as well? Do you see that?
Yes, I believe that there would be a lot of technological innovation as you are talking. There is a scope for technological innovation, and financial inclusion is also very much upcoming because we are already in the path of this financial inclusion. And if you look at these particular, I mean, if we talk about regarding this particular policy, I mean, as it was mentioned that we are keeping a lot of faith in the banking system, and from 1991 to now. So this confidence in the banking sector will definitely lead to more financial inclusion. So financial inclusion, and since banks are getting more flexibility in terms of CRR cut and all these things, so definitely I think banks will go for more financial inclusion.
Right.
And that is very much required because that will actually boost the aggregate demand as well. So whatever financial growth, I mean GDP growth or the economic growth we are talking about that is slowing down. So one big component of the GDP growth or the economic growth is this aggregate demand, which is coming from consumption. And a large part of the economy, if we can boost that consumption demand, so definitely that this aggregate demand will definitely bring some growth, positive thing on the growth.
Okay. Dr. Shettigar, how would you classify the approach of the central bank? Has it been more conservative, say not looking at finer details of inflation and focusing on the headline rate itself? How would you classify that, sir?
No, I got a different opinion. Especially, I mean, I don't fully agree with the so-called inflation targeting. Policy should be situation, whether it's inflation or the growth or any other the problem in the economy. That should be approached through the monetary policy in the same way as the government initiates the fiscal policy to address the prevailing economic situation. Now, as far as the inflation is concerned, the RBI becomes effective in controlling the inflation, provided the quality of the inflation is such that it is the demand pull inflation. In the case of the cost push inflation, I don't think that the RBI will be effective. In fact, got what you call the detailed research on that. It is only when there is a coordination between the fiscal authority and the monetary authority, RBI's approach becomes effective. That too, only in the case of the demand pull inflation. So in the case of the cost push inflation, more has to be done by the fiscal authority, that is the government, through the fiscal measures. So, but here the situation is more complex. Say one, it is beyond the control of RBI nor the government. It is the external forces like Federal Reserve or something. And moreover, as far as the FPIs are concerned, so they compare what you call the bond yield between their host country as well as the host country. Now here today's the policy approach. Now, if the interest rates comes down because of the rise in the money supply, that will also ultimately affect the bond yield because there is a correlation between the bond yield and the interest rate. There is bond price and the interest rate move in the two opposite directions. But when it comes to the bond yield, if the interest rates comes down, ultimately there will be fall in the bond yield. Now, if the bond yield comes down, whether you will be able to prevent the outflow of the foreign portfolio investors because they compare with the bond yield of their own country. Now, moreover, the chairperson of the Federal Reserve recently gave a hint that there may not be further cut in the Federal Reserve. If there is no further cut in the Federal Reserve, obviously the bond yield is likely to be higher in the US. And there is an additional reason for the FIs to withdraw the money. And moreover, they also expect some to improve the situation when Trump takes over.
Okay.
So these are the things we have to watch.
Prachi Mishra, last word from you, ma'am. Also help us understand how is all of this going to play out in the political economy of the country, because, you know, price rise, inflation are also political issues now being raised constantly by the opposition in every state. And also, you know, the economy, the politics of the country is also largely becoming welfare-centric. There's a lot of emphasis on banking inclusion. In all of this, how is this decision of the RBI going to play out?
Yeah, no, I think I have to say that, you know, higher food inflation, it's well established in the literature that, you know, inflation is a cruel tax and it hurts the poor more. And, you know, food inflation in particular hurts the poor more. So that is number one. Number two is, I think, you know, inflation generally is, as I said, is a broader indicator and is probably the most comprehensive indicator for macroeconomic stability. So I think, you know, if you come to the political economy, I think, you know, inflation globally has been established to be you know, a very important determinant of you know, political economy, elections, etc. So I think controlling inflation, especially in this you know, uncertain environment, a globally uncertain environment, I think would be top of the mind of policymakers. I think. Let me stop here.
On this broadcast, thank you, Professor Shettigar, thank you, Prachi Mishra, and thank you, Professor Dev, for giving us those insights. For the first time in over 30 months, the MPC of the RBI, expected to focus more on slowing economic growth, has come up with some key decisions. A 6-member committee led by RBI Governor Shaktikanta Das took these decisions during a 2-day meeting that began on the 4th of December. Despite inflationary pressures, what we understand from our panelists is that the RBI seems clearly optimistic about India's growth prospects. It's of course empowered by favorable monsoon seasons and also expectations of a rebound in capex. That seems to be the flavor now.